Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, May 23rd, 5:46 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. State of the market, we're in an uptrend since May 6th. That might have changed today, at least the first signals of a possible change in character. Market always needs follow through whenever you get a short-term signal, but not the best day today. So we still have the four green arrows, but market leaders, several of them breaking the 21-day moving average today. So we broke out the yellow arrow. And as far as the short-term trend goes, three of the indexes with very ugly negative reversals and a first close below the 21-day moving average, that being the Dow, the mid cap, and small cap indexes. All five are still trending above their medium-term 50-day moving average and long-term 200-day moving average. So what happened today? A lot to unpack here. Euphoria overnight on NVIDIA's earnings report, and it was just an absolute monster earnings report. 427% increase in revenue from data center products, and that falls in line with the thesis that we've been talking about for a while here. Data centers and all of the components that go into powering and supplying those data centers, all gapping up at the beginning of the day, and that sparked a gap up in the indexes. That lasted about 30 seconds, and the indexes put in the high immediately and had a very harsh sell-off for the first 30 minutes. Well, that sets the top and the bottom for the opening 30-minute range, and then we take a look at those ranges and see what happens. Do we break below? Do we get back inside? Do we get above? You look to this to get a tip on who's in control, but a high right out of the gate implies the bulls are not in control despite some of the very nice green numbers on these leading stocks. We saw small caps immediately turn red. We saw the Dow turn red, and we saw the S&P 500 go from a 0.6% gap up to flat. NASDAQ 100 still positive because of the big strength in NVIDIA. We had a bit of a bounce late afternoon, but really what happened is the gap up open was a breakout, and that immediately failed. And there's an old saying, and we know to pay attention to it when it happens. From failed moves come fast moves in the opposite direction. So we're very wary of that, double checking our stops, seeing how everything's acting that we hold on the day. And really, there weren't any red flags right away. Notice some weakness, but no stops getting triggered. And the rally, here was the problem, and I'll show this in the charts. The rally early afternoon went right back up to that 53.24 level, which was the breakout level. Tested it twice within 45 minutes, and then promptly rolled over hard, broke the opening range low down to the lows of the day, and broke the range from the 5-day consolidation. So that's immediately a change in character for the market because support didn't stand. A weak bounce into the close then. We'll break this all down when we get into the charts. But the bottom line is this is a failed breakout and a failed consolidation because we broke above and broke below. That at least puts in a short-term top. Now, is that a top? We don't ever predict, but we do know that we have reference points now of a high of a consolidation that got broken and the low of the consolidation. We can bounce back up into that consolidation. That negates the breakdown. If we break lower, that reinforces the fact that the breakout has failed and we get more defensive. So here are the final numbers on the day. The 21 over 21 list, slightly positive on the day, mainly because of NVIDIA. 6 names up, 2 flat, 13 down. The big 8, barely negative, again, because of NVIDIA being up 9.3%. Tesla dragged down 3.5%. The RG8, this is our 8 growth ETF composite, no real strength most of the day. The FFTY stayed green for a while, but the lack of breadth was dragging down the other components of this index, down 1.3% on the day. And on the day, ARC led to the downside, minus 3.1. And this is where we're looking at this as a possible short. S&P 500, if there's any positive, it's the fact that we undercut the recent prior highs and got back above it. Again, we'll look at that when we get to the chart. But going from a 0.6% gap up to a negative 0.75% to the downside, and some of the charts that broke, doesn't inspire confidence, nor does the equal weight being down 1.4%. Again, 87% down volume today. Really completely is the opposite of what you're seeing when you look at some of these data center stocks and NVIDIA. NASDAQ 100 finally broke and turned red after a 1% gap up, closing down 0.45%, equal weighted down 1%. The Dow broke hard, down 1.5%. Mid caps down 1.3%. Russell 2000 small caps down 1.6%. Higher interest rates certainly didn't help on the day either. Global diversified 60/40 down 0.5%. Our flagship portfolio, GROTECTION, down 0.39%, propped up by some of these data center leading stocks that we have. But we did reduce exposure significantly, and I'll talk about that when we get into the tail of the tape. Let's get into, where is my chart here? Here it is. Didn't bring it onto the other screen, but it'll be here in a second. So what you're going to see, I'm going to go first to the daily, and you don't have to look very hard to see the outside negative reversal to the downside. And a break of the 8-day moving average. But what's really more telling is on the 15-minute chart here, and we've been drawing this out for the last 5 days. This was the CPI gap up, and then multiple tests to the downside of this 52.83-ish level. On the upside, 53.25. Very clear that we broke above that and then failed immediately. And then here were the two back tests trying to get back above it. I texted the guys early in the day and said, okay, now we broke below the 30-minute range. Let's see if we can get back inside the range. And then to negate this failed breakdown, we need to clear back above this 53.25 level. Those two double failures at the 53.25 level led to the waterfall to the downside that not only implies the failed reclaim of the breakout, but also a break below this bottom of this 5-day consolidation that we've been in. If you draw a line from the bottom of that gap up day, we also undercut that. Didn't quite fill this gap, 52.50. There's a tendency for gaps to get filled, and we haven't been there yet. So that's the first target that we'll look at to the downside that needs to hold. And then below that is the 52.37 to 53. Really, it's 52.36 to 52.40. That should provide some sort of a resistance, and you can see that 3-day trading range that we had here before the CPI breakout and then the following consolidation. It's just one level at a time, but for now, definitely a very short-term change in character with not only the failed breakout, but also the failure of support on this 5-day consolidation that we had. So what we want to watch here is if we rally up into this 52.83 to 52.90 level, what happens there? If we fail there and roll over again, it's more of a concern. If we get back in this level here, sometimes these things are just one-day wonders. I'm going to point out when we get back to the daily chart for prior incidences of a similar outside negative reversal near the top, and we'll see how they ended up resolving. Let's go to that daily chart now. Obviously, you can see today, and the 4 that I'm focusing on are this one back on 7/27 of last year, which kicked off the first leg of the 3 waves down correction of last summer. This ultimately kicked off or resolved to the upside with this nice rally on the follow-through day in early November and kicked off this very strong move to the upside. During that move to the upside, We also had another negative reversal off the top in December 20th. That resulted in a 3-week consolidation that held the 21-day moving average before breaking out again. We also had a negative reversal on 3/8 off of the top right here. That was a 1-day wonder, although the next day low did get tested again, but in both cases, it held the 21-day moving average. The third one is this negative reversal that kicked off this recent correction. That was on April 4th. We broke the 50-day moving average there, based for 3 weeks, and then kicked off this latest move to the upside. Little consolidation and another gap up. 5-day consolidation. Consolidation should resolve to the upside. I mentioned last night, if they don't, then that's a problem, and this didn't. And that old saying, from failed moves come fast moves. That's where we are again. Now notice this 52.65 previous high. This was a target that we broke above. With this CPI gap up, we undercut and got back inside that level with the 52.68 close. So at least we bounced there. That's one support area. And then filling the gap is the next level down. Take it one level at a time on the indexes. Now then, after the indexes, you go to isolate leadership and weakness. And we'll talk about that in a moment too. Let's go on and finish the indexes. Here's the NASDAQ 100, very similar outside negative reversal, still holding above the 8-day moving average. So the most powerful of the indexes and leading for the last 5 weeks on a relative basis. The Dow Jones Industrial Average, unfortunately, with this big candle down. So for now, this is a failure at the 40,000 level. Again, from failed moves come fast moves, breaking the 21-day moving average. We want to see an immediate reclaim of the 21-day moving average in order to classify this as just a failed breakdown. But for now, it's a failed breakout. Let's go to the S&P 400 mid-cap index. Also a failed breakout here. Break of the 21 sitting on the 50-day moving average. That happened pretty quickly. So we went from 2 weeks of relative strength to a week of major relative weakness and making a lower low on a relative basis well before price is. That's a significant sign of weakness. Let's go to the Russell 2000 small caps. Challenged these recent highs, never were able to get above it, and then this big candle today. So again, we had choppy relative strength for 3 to 4 weeks, now showing relative weakness again. This relative strength line near making a low, hasn't quite done it yet, but look at how far price is up there. Relative strength. When you make a new high before price, it's very bullish. When you make a new low before price, it's bearish. And again, with this, we want to see it get right back above the 21-day moving average. That's going to be a problem because of the strength in interest rates, as the 10-year was challenging that 4.5 level again today. And we'll be there in a second. So those are the 5 major indexes. Let's go to the VIX. VIX just came down too low, not really up that much considering the 87% down day, but up 3.9%, ran into the declining 21-day moving average, still below that 16 level where the market has done its best work over the last 6 months. Here's the dollar. This is making a higher high and higher highs and higher lows. Now this could devolve into a bear flag. That's what market bulls would want to see. But for now, we're making higher highs and higher lows on the dollar, and that is not bullish for stocks either. We'll go from the dollar to the precious metals. They had an ugly down day yesterday and followed it up with another one today. Gold down 2%, breaking the 21-day moving average. Gold stocks down 2%, breaking the 21-day moving average. Silver down 2.4%, still holding its breakout level here. Bitcoin showed recent strength, but not today. Sitting on the 8-day moving average, negating that big move up of 3 sessions ago, down 3.6%. It's critical that this holds this 21-day, 50-day moving average support level, which also coincides with this recent breakout. So multiple levels of support there. Trading 24/7. We could wake up tomorrow and this could pierce this. I am seeing news after hours that Ethereum ETFs got approved. That's given Bitcoin a little bit of a bump here. We'll see how tomorrow resolves. We'll take it one day at a time, as always. On to bonds, the broad bond index to the downside, down 1/3%. Now, we're in a trend here for about 2 weeks now of making lower highs and lower lows on the bond index. That means that uh, interest rates are making higher highs and higher lows. Let's go to TLT. Not quite as pronounced, but it's there as well, trending to the downside. Now, this could end up being a bull flag, and that's what stock market bulls will want to see. If this breaks out to the upside, that means interest rates are coming back lower. But for today, it was down, and that means interest rates are higher, and that is a death knell to small cap growth stocks, higher interest rates. The 10-year, you can see the higher lows and higher highs that yields are making ran into the declining 21-day moving average. So again, stock market bulls want to see this rise in interest rates fail. Stock market bears want to see this continue to form some sort of a basing pattern and eventually yields going higher. There was some strong economic data that came out after the open that certainly didn't help the stock market bulls cause, as we're wanting the Fed to start lowering interest rates, or the market is wanting the Fed to start lowering interest rates. But if the uh, overall economy stays too strong, there's going to be a problem there. And there you see higher highs being made over the last week and a half on the 10-year as well. That challenged this 4.5 level, pulled back of it a little bit, but that was responsible for some of the market weakness today. So that's our inter-asset correlation. Let's go to the tail of the tape. One bad day is all it takes sometimes to flip some of these indicators, and all 8 of the RG8 had their stochastics roll over. I already mentioned 3 of the 5 indexes rolling over there as well. And, the news again of the day. Monster earnings report on NVIDIA sparks a gap up and an ugly negative reversal. So our day count goes from a 5-day consolidation to a failed breakout and 1 day down. First close above the 8-day exponential moving average, still 15 days above the 21-day. And we want to see what happens if we come into the 20-day, obviously. But breadth is a mess. And things changed quickly. And you're foolish to not pay attention to them. So let's go to sectors. The only sector, actually, it wasn't even SOX that was up. SMH was up. There are two. The SOXX and SMH are the two major semiconductor indexes. SOX was negative by 0.5% today. SMH was positive by 1.4%. Has something to do with ASML and TSM. I'm pretty sure those two are in the SMH, but are not in SOX. I think the SOX sticks to just the domestic chip makers. But anyway, SMH was positive, not SOX. And here again, more signs of weakness. All 11 of these spider sectors lower. Early in the day, tech was holding up pretty well. It was all the value sectors that were lower, but one by one, they all started going red. So the day started out with the value flowing into growth. Value still across the board had a much worse day than the growth half of their components. For example, big cap value down 1.4, big cap growth only down 0.2. That's the SPYV. Let's take a look at this real quick. This is going to be a long video. SPYV breaking below the 21, SPYG only down 0.1%, and really it looks like the NASDAQ 100. Same thing with, let's see, the Vanguard VTV Value Index, breaking the 21-day moving average down 1.3%. VUG, it's configured slightly different, but again, this looks like the growth half. This looks like the NASDAQ 100. All right, where are we? We're back here. And so sectors to the downside. Gold, and silver stocks, solar, biotech, and banks were the worst off. From a portfolio standpoint, we added to NVIDIA early, overnight last night and pre-market and early in the session. When things started to reverse, we trimmed PSTG. When things started to break down, we sold our SSO, reducing our index exposure, locking us a gain for there, similar to PSTG, locked a gain there. Took small losses in ERX and FAS. We already trimmed those, and they just continue to act weak. So that's an oil ETF and long banks, and we got stopped on those for below the minimal 0.1% target loss that we take on a starter position. Carrier just not making any progress. We wrapped up a very small gain on that, and then we put a hedge on with SQQQ when the NASDAQ 100 turned red and we weren't seeing any bounce. So big reduction in our overall exposure, cutting it from 1.45 to 1.09. As long as we're above the 21-day moving average, we kind of treat this as a floor of 1.0 because, well, the indexes are going to do what they're going to do, but as long as they're above the 21 and the 50, that means there's enough positive action in the stocks to hold them above that short-term moving average. So we don't want to throw the baby out with the bathwater, but we did trim some of the weaker things. And then this SQQQ hedge gives things a chance to play out because we do hold a lot of good-looking names, and they held up well today for the most part. We're going to go through these charts in a minute, but the bottom line on the day, NVIDIA sparks a gap up breakout, which turned in immediately into an ugly negative reversal. 3 of the 5 indexes breaking below their 21-day moving average. A lot of the bullishness that was showing recently and after hours dissipated today. Let's take a look at some of these names and see what story they're telling. So we're going to go to the 21 over 21 list. We're going to go, this will include going through our portfolio holdings, and we'll see what conclusions we can draw from this. So there's ERX. We got stopped out on that, breaking below the low of the range, no tolerance for losses. Thought we caught the turn on this, but we absolutely did not after the last 4 days down. VDX, still holding on to a partial position in this. Doesn't have much room left in it before it'll take out our remaining position. American Express, recent leader, but relative strength laggard over the last two weeks, breaking below the 21. Carrier, this is a peripheral, has peripheral ties to heating and cooling data centers, but not showing relative strength, about flat. And when you're reviewing your portfolio, you want to pull the weeds and water the flowers. And this wasn't necessarily a weed, but it's a flower that, let's say, didn't bloom. So we blew it out. Tava still holding up there just fine. XLF, we had the FAS, this breaking the 21 corresponded to getting stopped out on the FAS. This is still holding up fine. This is Howmet, AppLovin, sitting on the 21, Goldman Sachs. You can see a lot of these not broken in any way, shape, or form. They're just normal pullbacks. Most of them still at or above their 8-day moving average. CrowdStrike, normal pullback below average volume, our largest position. No problem with this one at all. Cameco, uranium down 3 straight days as commodities have taken a hit, but this is still fine above the 21-day. First Solar gap down, was down between 4 and 5%, but rallied nicely and surprisingly, I must say, holding the top of this long flat base. Nutanix reversed, not a surprise, still looks fine. Pure Storage on the gap up and the fill of the gap, we took partial profits. Freeport, copper breaking the 21-day moving average. Micron attempted a breakout. This is very much tied to data center. This is storage chips for data center servers. Negative reversal, but just barely negative on the day. And this hedge is designed for stocks like this to give these a chance to decide whether they're going to work or not, or see whether or not the indexes are going to take the leading stocks down with them. Transmedics continues to be very strong, Constellation, positive. This is also tied to data center power. Spotify holding up nicely around that 300 level. Vertiv, this made a all-time high before pulling back along with the rest of the market, but this is right there in that sweet spot, liquid cooling for data center servers. Abercrombie and Fitch continues to act well. PDD, second day up after earnings, continues to act well. And NVIDIA, you've got the big gap there. So the big red flag on NVIDIA would be if we break below the low of the gap up day today, which in this case, my voice is going. We break below 1015. We got a problem before that. And then the next level down would be the Livermore 1000 level. You do not want to break a major psychological level. One thing to remember, and Ted pointed this out to us today, he's on vacation, but he can't help himself because he's addicted to the markets. This is the, count them with me, one, 2, 3, 4, 5, and you can't see it back here, but this is the 6th gap up and beaten raise on NVIDIA. That's something I'm just going to say, one of the O'Neill rules. Everything looks fantastic for NVIDIA right now. One of O'Neill's sell rules is that you buy on technicals and fundamentals. You sell only on technicals because the fundamentals always look best at the top. You can point to the growth. You can point to whatever you want to. It's very possible that NVIDIA will continue higher, but may need to form a base. I know it just broke out of a base. So if it goes back into this base, that's a failed breakout. And despite the stellar fundamentals, that would be telling you something. If we get back into this below this 974, 967 level, if you fall back into the base, it's a failed breakout. And you can't argue with price or the structure. And what you ultimately do is up to you, but we point out the things that we look for. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Our flagship portfolio is named GROTECTION. It's designed to grow assets during uptrends, which we've been in after resuming after this consolidation that held at the 20-week/100-day moving average. But today, a failed breakout from a consolidation. From failed moves come fast moves. We've got 4 reference points for various types of action that can happen. All you got to do is look back over the past 9 months to see it happen repeatedly. Sometimes it was signs of a top. Sometimes we just continued higher. In 2 of the cases, we started breaking down. In 2 of the cases, it was a non-event and we continue to go higher. We won't make any judgments about what it is. We will point out the deteriorating breadth, the breakdown of the 3 major indexes below their short-term moving average, and the fact that today was an 87% down day. The bulls had the ball with a breakout and fumbled it. And whether or not the bears recovered or the ball still squirting around, that's what we need to determine tomorrow and going into next week. And with that, I'm going to wrap it. This is Don Vandenbord with Revere Asset Management, telling it like it is for Thursday, May 23rd. Thanks for listening and have a great day.